So there are 3 credit agencies, okay, and your score usually comes from these 3 credit agencies, and they're not one is better than the other, just different credit cards pull from different ones, different banks pull from different agencies. And it's Experian, Equifax, and TransUnion. Experian, Equifax, and TransUnion. And usually those 3 credit agencies for you have about the same credit score. They're not always the same, but they're usually very, very similar, okay? So what is credit? Well, credit is a number assigned to you based on a couple different factors, and we'll talk about that in a second. But the number tells lending institutions, who usually don't know you from Adam, how likely you are to be responsible with money, how likely you are to pay on time, to pay it back. And obviously, the higher the credit number, the better. So, Pam, I'd like to share my screen right now, if you're able. Sorry, I'm really close to the camera.
Yes, let's see.
Hello, everybody. Oh my gosh. All right.
Hold on.
Share me.
Julia, I'm going to have to make you the host, and then when you're finished sharing your screen, so I'm going to switch it to you. Now you can share your screen. At the bottom, green.
Oh, share screen.
Green arrow.
I'm a Sharon.
Yep.
Okay, here we go. So I believe you guys can see this. So, okay, so what you want to see, this is an overview of credit. And so you see, like, credit starts at 300 and goes all the way up to 850, okay? And so you see from 800 to 750 is excellent. 750 to 700 is pretty good. 650 to 700 is fair. And pretty much anything below 650 is, you know, really in the red zone. Okay, so those are the different scores that, you know, people could have. Okay, there are a couple different factors that play into this, and actually, before I go into that, let me share this. One of the websites that I think is fantastic on credit scores, and I'm going to show this to you. I have it pulled up. It's credit. Oh, it logged me out. CreditKarma.com. I don't know if you all are familiar with CreditKarma.com, but you know, I logged in here, and it's free. And the way that they make their money is by they're able to recommend credit cards or financial options for you based on your credit score. And that's how they make their money, is through they're able to advertise. And so this is my actual credit score, and it shows me 2 of the 3 credit, you know, credit bureaus. And so you see, they're not exactly the same, but they're very, very similar. And so that's a fantastic way to recommend that to your consultants, to actually know their credit score. And by pulling this, it does not count as a hard ding on their credit. So what I want to go through are some of the factors that actually affect credit. Okay, let me pull that back up again. Where are we here? Here we go. Here are the different things that affect credit scores. Okay, so and I want you to pay attention. There's basically 5 to 6 things that affect credit scores. One is your payment history. 35% of your credit score comes from payment history. Are you paying bills on time? Obviously, if you don't pay on time, that will negatively impact your credit. The second thing is amount owed, meaning your available credit, like how much credit you have available to you versus how much are your credit cards, how much of a balance. So my one credit card I have is like 30,000, you know, on it, but at any given time, I just have a couple thousand charged on it. So I have a lot of leeway on my credit. And many times what I'll do, I'll call my credit card like once a year, and I'll just ask them, can they up my credit, my available credit? And they'll get back to me yay or nay, but they'll keep upping it as I keep asking, because that looks better when you have more possibility to spend, but you're withholding, you're showing restraint, and you're not maxing it out. So if you have cards that are maxed out, particularly over a long period of time, that would negatively affect your credit. Okay. The third thing would be the length of your credit history, meaning the longer you've had a credit card open, the longer you've had a home mortgage or home equity line, or longer you've had, you know, a car loan. The age of your accounts is important, and we'll get to in a little bit, because one of the factors that we might run into are people who say, I don't have bad credit, I just have no credit because I'm new to credit, okay? But anything over 10 years, particularly having a credit card for up to 10 years, it looks very favorably on your credit score, okay? The next one would be the mix of credit, like the types of credit used, your mix of accounts. So it actually helps your credit score when you have a home loan and a car mortgage and credit cards. You've got a couple different financial institutions that you are that they are lending you money, so that is positive for credit scores. And the last thing would be new credit, meaning the number of inquiries to your credit. So this is important for you as a sales director to understand this, that whenever you apply for a credit card, whenever you apply for a loan or a car loan, etc., when a financial institution has to go to Experian, TransUnion, or Equifax and ask what your credit score is, that counts as a hard ding. And it will actually decrease your credit score a couple of points. Now, if you're shopping for a home loan and you're shopping around and you go to 3 different banks to try to find the best possible bank, credit bureaus understand that, and 3 dings in a short period of time means you must be shopping for a home loan, and that's not going to negatively affect your dings as much as just applying for 10 credit cards would be, okay? But those are things that will negatively affect your credit. The last thing that's not on this chart is our derogatory remarks, meaning if you have a bankruptcy or anything has been sent to collections on you. So if you run into a new beauty consultant who, you know, has had a bankruptcy or collections called on her, it's very, very unlikely that she's going to be approved for a card. The reason I want to go over this with you is because I want you to understand the credit score isn't this magic number. It's actually made of real data. So one of the obstacles that you can come into is when you have someone who's young, there's just no data on her yet. She hasn't had the opportunity to have credit. And so I want to unshare my screen now, and I must go to stop share. Is that right?
Yeah, and then you're going to throw it back to me as host so we can answer questions.
Okay.
Click on my picture, and then you're going to see those little dots.
Yeah.
Okay.
Make host.
Yep.
Okay. All right. We're good. All right. Let me get back to my notes here. Okay. So back to the obstacle of if she has no established credit history. Okay. Where does she get credit? Well, the first thing I want you to understand about this is that her beginning her credit history is a good thing. Okay. And I want you to be able to speak with authority to your new gals who have no credit yet, is to say, girl, do you ever want to buy a house like later in life? You know, do you ever want to be able to get I mean, obviously I want them to earn these with a car through Mary Kay, but you want to make sure they understand that their beginning of credit right now, as long as they manage it responsibly, is a benefit to her later on down the road. You know, when my dad immigrated to America at age, 35, he wanted to buy a home, and the American banks were like, sorry, you don't have any credit. And he was like, what do you mean I don't have any credit? I'm a responsible 35-year-old hardworking man. And someone had to explain to him, you have no credit. Even though you're a hard worker, it doesn't mean anything. We have no data on you. And so he had to learn the process of getting credit. So her actually getting a loan for her Mary Kay business or a credit card is actually a positive thing for someone who is young. Asterisk, as long as she manages it responsibly. Okay, so what do you do when you run into that? Well, there are 6 things that I want to give you, 6 notes on this point. Okay, the first thing is, back in the day, we would recommend co-signers. And now banks are actually, instead of co-signing, they're more so leaning towards recommending a parent or someone with good credit to add her as an authorized user. So I write down authorized user. When you have an authorized user, essentially, someone has the main credit card, and then authorized user, you have, a credit card in your name, but you're ultimately not responsible for the payment. The main person that the credit card is in is still ultimately responsible for that. But if you add an authorized user, she can get a card in her name, and she can essentially piggyback on someone else's credit history. And after some time, it's shown that the primary card holder's credit does positively or negatively influence the authorized user credit a little bit. Okay, so that's the first thing. The second thing is, maybe she's young, but there's a good chance that she has a bank account. And so I think one of the obvious steps is, if she has a savings account or a checking account, suggest she start at her bank, okay? Because at her bank, where she has a savings or checking, is a bank where she has a relationship there, okay? So the second part is, recommend she go to the bank she's already banking with because they know her. She has a history with them. The third point is, I gotta say it, I love a loan. I love a loan. I love a loan. It's actually my favorite, 10 times over a credit card. Any day of the week, I'll recommend a loan. And I think that we tend to veer folks towards a credit card because you can apply for them quickly. You can easily apply for them over the internet. You don't have to walk into a bank. And there's nothing wrong with veering people toward a credit card. I think it's just like we've just gotten into a habit of recommending credit cards. It's just like what we do. But, oftentimes also the word loan could kind of scare someone off who's younger. the word loan just seems kind of a big deal. But I believe that we have a better shot at actually keeping our new beauty consultants when they get a loan, simply because there's more accountability there. The payments for a loan are spread out over time. There is a set payment schedule. It provides a genuine opportunity for her to build credit and to establish a relationship with a local bank. With a loan, you just feel more inclined to make a payment on time, I think, because there's an actual entity who is expecting an actual payment versus a credit card where you have the option to make a minimum payment, right? There's no minimum payment on a loan. Where the credit card, there's the option to not pay the full amount. You can just pay a minimum payment instead of the full payment. And I just think it's very tempting to simply pay the minimum payment. Okay, so can you see where a loan would build in more accountability, particularly with a younger person who doesn't have credit? You want to make sure you're establishing good habits, good financial habits. And all right, the fourth point is I love credit unions. I love credit unions as much as I love loans. Okay, why? The reason why I love credit unions is because you may not know what is a credit union, but a credit union exists for the consumer instead of a for-profit bank. So for that reason, because they exist for the consumer, they're not really out to make a profit or as much profit as a regular bank. So credit unions are notorious for not only being easier to acquire credit, they're way more lenient at giving younger people loans. They typically have lower interest rates and significantly less fees. Okay, so I would suggest to make credit unions your friend. When I was a student at the University of Kentucky, I walked in the UK Federal Credit Union at the age of 19, and I walked out with a car loan. No questions asked. It was like bada bing, bada bing. Of course we'll give you a car loan. And it was very empowering to walk in as a teenager and walk out with a loan. I felt so grown up. So credit unions used to be kind of hard to get into. They used to be just for teacher credit unions or university credit unions. And now, in my town at least, there are several other independent credit unions where you don't have to be affiliated with any certain group. And I'm going to guess that that might be the case in your area too, that more credit unions are popping up. And why are they popping up? Because they work. Okay. The fifth thing I want to suggest for someone who has no credit yet or little credit is because, little credit would be going to creditkarma.com, like I just mentioned. The reason why I like Credit Karma is simply because they recommend credit cards that tend to accept people with that credit score. So Credit Karma is in the business of finding cards that will work for people with that credit score because that's how they make money. They don't want to recommend a card that someone is not going to get. And so if you've got someone with a beginner credit, you know, oftentimes they're going to be approved for like a student credit card. You know, a student credit card is a lower credit limit, usually like maybe $500, but at least it gets them started with building credit and building a credit score. So at least Credit Karma will point them to a direction where they have more likely chance of getting approved. Okay, and the sixth thing I would say for someone who's starting out with credit, you know, would be the Mary Kay credit card. I asked some of my directors, you know, what credit score do you typically have to get to at the Mary Kay card? And I think it was around 670-ish, maybe. Maybe some of you all know better than I know because the Mary Kay credit card kind of came about after I was in NSC. But that 670 range is like in the fair range. Okay, and so that's probably a real no-brainer because that's right there on your computer screen. But that is another really good option. So just to review, for someone that has no established credit, I would say suggesting an authorized user on a current credit card. Number two, go to the bank she already is at with her savings or checking account. Number three, encourage her to get a loan, maybe from the bank she's already at. Number four, encourage her to get a loan or a credit card from a local credit union. Number five, send her to creditkarma.com so that it points her in the right direction with which credit card for her score. And number six, the Mary Kay credit card is a great option.